So, Stephen, we saw a bit of a rally on Friday following those comments from Goolsbee and from John Williams. Right now, we're seeing futures higher. How do you see today shaping up?
Well, look, this is the holiday period. We can move markets around a great deal on just a little bit of momentum and inertia. There's not a lot of friction going on there. All these, physics terms of investors really participating. So you can have markets move off track a little bit in a volatile way, but it's really not meaningful in terms of price setting and figuring out what the economy will look like, or really what the investing landscape will look like in the coming year during a week like this.
All right, so we mentioned the rough week for the markets last week. What is your word of the day? How do you see today and this week shaping up?
Well, again, it's momentum. It's that we can just find periods when investors latch on to a rising trend or a falling trend and push it just a bit too far. We had a return in the last 24 months, of 58% in the S&P 500. We think, again, that momentum is going to change some, that we will have positive returns. We're not negative on the outlook for the economy, but the rebound that we had from that awful 2022 is out of the way now. And we're going to focus in on some changing fundamentals. A decade of double-digit returns in the S&P 500. We think that, again, there are wider investment opportunities, and especially for the decade ahead, if not the year ahead, you want to make sure that your portfolio is not attached solely to the performance of the drivers that are behind us.
All right, so again, your word of the day is momentum. While we're looking at things that have happened in the past, I'm going to go back to the previous government shutdowns and things like that. We avoided one this time around. But if you don't mind, just kind of going to your memory banks, when we look at the impact that some of this disruption has on the markets and also investor confidence, is this something that we need to worry about, just this, this fiscal, quote unquote, dysfunction in D.C., and also the possibility of the U.S. credit rating being downgraded again if you want to look back to August of 2023? Is that something that you're worried about when you look at, different people that you're advising and the markets overall, the idea that we could get downgraded and that could lead to bond yields rising?
Government shutdowns have been really short-lived and have had minimal lasting impact on the economy. In fact, markets have even looked through them largely. The issues of debt ceiling fights in the past have sometimes been more meaningful. And again, it really comes down to, is there a small possibility of some accident that will harm the bond market, that will cause capital flight from the United States? It's a remote possibility. Now, there are plenty of different roads to higher and lower interest rates. Stronger growth, the end of disinflation, some inflationary policies, and tax cuts beyond what we already have, that could lead us to somewhat higher bond yields. We do think that the long end of the yield curve will gravitate a little bit higher over the course of next year. We think that the Federal Reserve is still easing. It's not going to ease quite as much as everyone thought at the middle part of last year or the fall of last year. But we've still taken some of the risk of disappointment about the Fed out of the market just this past week. 85 basis point rally in the two-year yield. We're now probably pricing in a little too much tightening, or just not as much easing as we will actually see from the Federal Reserve after the comments from Powell last week.
Stephen, I want to get to your pick right now. What is your pick for us today and why?
Well, I don't have a pick for you, but I will tell you that the healthcare sector, broadly speaking, has been trading with extremely low confidence, weak earnings right behind us. And we're expecting that EPS gains will continue on this recovery track. So this is the secular growth industry that's like tech, but it's treated, again, with very low confidence. And we think that should be part of portfolios.